Now RSI, the stage 1 or the basic setup of RSI is that, by the way, it could be 70-30, it could be 80-20. Default settings are 70-30. You can stick to 70-30 as well. The more popular setting is 70-30 actually. So let it be like that. So stage 1, if you all can recall, was people, you buy when the price enters the oversold zone. Correct? Because the stock has been butchered badly recently. So it means too much of battering has happened. It's like you have done an over punishment to the stock. That's why it has become oversold, which means average losses in the last 14 days must have been heavily higher than the average gains. So the stock has been over punished. So people buy it when it enters the oversold zone. But the biggest problem with this is this can continue for many months. And as long as the stock is falling, this can continue. The stock can continue to stay itself in the oversold zone. And you will see erosion of your capital continuously. So stage 1 actually is not recommended. Similarly, sell when price enters the overbought zone. Okay, these things are not good. Okay, because if the stock has a positive momentum, it is running madly. Okay, it has a positive momentum. How can you sell that stock? It's like coming in the way of a bullet train. So the moment it is done rising any further and it's not rising anymore, and then it has started falling, then you should actually sell it. Similarly here, when it started rising and crossed a particular point, then you should buy. That thing has to be very clear. And for that, we have stage 2. So people who are a little bit more aware of the concepts of RSI, they'll be buying when the price exits the oversold zone. Fine. Similarly, they'd be selling when the price exits the overbought zone. Till here we had already done. Now we are coming to stage 3. Stage 3 is divergence. Using divergences, not convergence, divergence, but divergences to trade. Now, how to trade in divergences again could be of many types. Divergences are bullish, bearish. Divergences are strong, weak. There are many more things to talk about. But what exactly do we mean by divergences? So as I've said, as a common meaning, you can consider divergences as if that RSI is moving in a different direction. Yes. And stock is moving in a different direction. Ideally, we say price is always the fastest, correct? Price is the fastest. Any short length moving average of that price is slower. But any long length moving average of that price is even slowest, right? Price being the fastest, any moving average being slow, and that's why they are lagging. So which one do we trust in case of moving averages? When a fast line goes above the slow line, we trust that, correct? We move in which direction? We submit ourselves to which line, the faster line or the slower line? Always the faster line, right? We follow the faster line. When faster line goes up suddenly, it must cross the slower line first before it goes up. And the moment it does that, or even if it is looking to cross the slower line and there's a convergence which is going to happen, before that only we try to predict that there is going to be a crossover and we take a position according to that. So we always trust the fastest line, and the fastest one, we had always thought of it to be the price of the stock. But let me tell you, there is something which is even faster than the price. price is actually not the fastest. It is the leading indicator. Because something which price may not show, a leading indicator can. So a leading indicator can actually be even faster than the price.